So today I'm gonna present to you about Fresco company. My name is Wikarnda Kanya. So first of all, I can tell you about the background of the company. So our company came from combining two words, which is fresh and coconut. So in Spanish, the word fresco means fresh. So we want to produce a fresh daily product to every customer. And now our company have two products, which is coconut and orange juice. But in the future, we wanted to produce more branches of product. Maybe it would be mango juice and watermelon. And the next thing I'm going to present to you is about the WACC. At first, the company needs to know the cost of the capital from the cost of debt and the cost of equity, which cost of debt, WD, refers to the funds that are borrowed and must be repaid at principal and interest back as a lender at a later date. While the cost of the equity, WS, comes from funds invested by shareholders, from owners with expected capital gain and dividends. Here, okay. Next one thing is how we use to calculate. Our group uses the formula WD times RD plus WS times RS, and we get the WACC here, which is 10%. By rate of RS, we classify the risk fee plus market risk and market risk premium here, risk free and unreal beta. So this is how we calculate our RS. And RD percent, we use WD plus tax rate in Thailand. So this is how we calculate our WACC. So the next thing I'm gonna present to you about the expansion project of our company. So Fresco juice box here. Has forecast on their sales increasing more than 20% of their strategy to invest in product in different their product line by considering new projects to serve new increasing domestic demand and foreign export in order to capture more new shareholders. The cost of the equipment proposed is about 20 million baht here, as you see here, and the life expansion of this equipment is about 5 years. So the next thing we're gonna talk to you about the cash flow estimation. So the first thing I told you about the first price we set up per box of juice of our Fresco is about 15 baht. We set the price at this rate because we want each customer to be able to reach a product, and we slightly increasing price every year. So over 5 years, the product has been increasing slightly, and now the price is about 16.24 baht. And the variable cost per unit. The variable costs are corporate expense that vary in a direct proportion to the quality of output or unit sold. Variable costs rise whenever production expands and fall whenever it contracts. As shown in the table here, variable costs increasing overdue to increase the units sold over 5 years. Here. The variable costs may consist of wages of the labor and the salary, and materials that used to make a Fresco juice box, the raw materials such as fruit, sugar, and other ingredients that we need to make, and the electricity bill and also the water bill are considered the variable cost per unit. And the non-variable cost per unit is that changes in non-variable costs mainly come from the fluctuation in the advertising cost. In the food industry has a huge influence on customer product design, high quality fruit, and also customer will remain hurt will not. It depends on our company image. So the non-variable costs may include store rental, advertisement, and maintenance of the company. And for the equipment, the project requires about 20.750 million baht for equipment or machine used in producing Fresco juice box, which costs 20 million baht, and the rest of 0.750 million baht are from the investment in working capital.
In this part, we will talk about the evaluations of investment project. First of all, I will start with the payback period or PB. The payback period is the time it takes for a project to repay its initial investment. This one can be measured in terms of years and months, depending on the life of the project. From the calculations, we found that the company required 3.1 years, which is approximately 4 years for the cost to repay off investment by net cash flow generated by the asset. But you should not use only PB to do the decisions on the project, although it is attractive for you, since the annual cash flow of each year ignores the time value of money when the year passes. So you should use the PB compared with others to do a decisions on one project. Next one is the discounted payback period or DPP. The discount payback period is the capital budgeting procedure used to determine the profitability of a project. This variable will give the number of years it takes to break even from the undertaking the initial expenditures by discounting future cash flows and recognizing the time value of money. The company can use this method to assess the potential benefit of undertaking a particular business project. From the calculations, we found that the discount payback period of the company is around 4 years. This amount tells the companies about the time period in which the initially invested funds to start a project would be recovered by operating cash flow. And please note that this discounted payback period ignores the cash inflow from the project after the payback period. Next one is the net present value or NPV. The net present value is the calculations used to find today's value of future stream of payment. It accounts for the time values of money and can be used to compare investment alternatives that are similar. Note that any project or the investment with a negative NPV should be rejected. From the calculations, we found that the present value is equal to 41,734,927 baht, while the net present value of our company is 20,984,927 baht, which this positive NPV value means it can cover the initial investment and will also be profitable. In summary, we will be able to do this project. And by comparing with those two previous methods, this method is better and more accurate than both payback period and discounted payback period, because the NPV is it accounts for time value of money.
For profitability index or PI is using to tell whether an investment should be accept or reject. Therefore, to accept a project, PI need to be greater than 1. And on the contrary, we will reject a project when PI is less than 1. So PI will tell how much value we will receive per Thai baht invested, and we use the present value of future cash flow divided by the initial cost. As you can see from the table, the company has a PI of 1.63%, which means this project will be accepted because it's greater than 1. And for the internal rate of return, or IRR, is the discount rate that makes the NPV of project 0, or in other words, it is the expected rate of return that we will earn on the project or investment. So a project should be accepted if its IRR is not less than the company's cost of capital. So in a project of Fresco juice box has the IRR equal to 57.704%, that greater than the company cost of capital, which is 10%. Hence, we can invest this project because IRR is greater than the company cost of capital. And lastly, modify internal rate of return, or MIRR, used to measure the return of the project and compare it with the other potential project. So it uses the traditional internal rate of return of a project and adapt it to assume the difference between the reinvestment rate and the investment return. And MIRR is more accurate than IRR because it considers the cost of capital as the reinvested rate for a firm's positive cash flows and the financing cost of the discount rate for the firm's negative cash flow. Our project modified internal rate of return is the 33.453%, which is greater than the expected return, so we can invest this project.
So I will be taking the part of the sensitivity analysis. So our first variable is the cost of the machine. The cost at 0% start at 5 million baht, and the NPV is at 934,797.05. So when we increase or decrease the cost by 30%, when we find out that the NPV is changed more than double, so we can conclude that this variable have high sensitivity. And our next variable is the salvage of new machine. In this variable, the NPV is the only thing that changed, no matter how percentage it changed. So the cost at 0% start at 2 million, and the NPV is at 934,797. So when we increase or decrease the cost by 10%, the change in NPV is at 10.63%. So it is slightly higher than 10%, so we conclude that this variable have high sensitivity in the same amount. The next variable is the selling price of both machine. In this variable, the initial investment and the NPV is the only thing that changed. The cost at 0% start at 1 million, and the NPV is at 934,797.05. And when we increase or decrease the cost by 20%, the change in NPV is at 17.12%, which is lower than 20%, so conclude that this variable have low sensitivity. And the next variable is the inventory. The inventory, the cost at 0% start at 800,000, and when we increase, and the NPV is at 934,797.05. And when we increase or decrease the cost by 30%, the change in NPV is at 9.73, which is lower than 30%, so we conclude that this variable have low sensitivity. The next variable is a account payable. The initial percentage start at 200,000, and the NPV is at 934,797.05. And when we increase or decrease the cost by 30%, the percentage change in the NPV is at 2.43, which is lower than 30%, so we conclude that this variable have low sensitivity. And the next variable is the revenue increase. In the revenue increase, the initial percentage starts at 550,000 and the NPV is at 934,797.05. And when we increase or decrease the cost by 20%, the percentage change is at 35.69%, which is higher than 20%. So we include that this variable have high sensitivity. So our last two variables is the expense decrease and the WACC. For the expense decrease, the cost at 0% start at 800,000 and the NPV is at 934,797.05. And when we increase or decrease the cost by 10%, the percentage change is at 19.46, which is higher than 10%. So we conclude that this variable have high sensitivity. And for our last variable is the WACC. And the WACC, no matter how much we change the percentage, the outcome is still the same and the NPV also stay the same. So we conclude that this variable is constant and it has no sensitivity.
Okay. For the scenario analysis, it's a method of the predicting future value of the portfolio investment based on the potential events. In the other words, it's a method of the estimating will happen to portfolio value. The scenario could be used to examine what would happen to the project MVP if the several of the input out of the better best case or the worst case than we expect as best case. By the assuming probability for each case, we can find out the only expected value of the project MVP, but also its standard deviation for the coefficients of the variation to get a better idea of the project risk. On the base case, the expected case determined by using the assuming that we consider most likely to occur 50% of probability sell the 1 million units of the product at the price 15 baht per unit. According to this table, the essential investment after selling the cost the old machine 4,004,000 baht. We expect that in the year 5th, the cash flow will approximately 3,150,000 baht, with the NVP equal to 934,797.05 baht. As a base case, the essential investment would reduce around 40% of the base case, with the higher unit sales from the 1 million units to 1.25 million at the price 18.75 baht per unit. In short, the business reduced cost and also increased the product price lead to increase the sales revenues. It might be because of the good management in working capital, the higher in salvage value, which may cause by work begin more efficiency and productive. Additional, with the good marketing part, we could boost the unit sale while increasing the unit price. Thus, in the year 5th, the net cash flow will equal to the 1,452,005 baht. After the sum up with the salvage value, take on the salvage and recovery of the working capital with the NVP 3,900 up and 4,247.83 baht. On the last one, worst case, the table shows the initial investment is greater than the best and 750,000 units sales in the price 11.25 per unit. In other words, there are the highest costs in equipment and plants, high costs in operating, and low unit of sales, thus reducing the price. Furthermore, low of the salvage value can be the implied that the machine salvage is inefficiency, as the net cash flow equal to 2,847,500 baht at the year 5th, with the interest rate is the 12.5%, the NVP minus 1,084,760.3 baht, which means after year 5 of the investment, we will get lost because it does not return adjust for the inflation. For the scenario summary, according to the scenario analysis part, show that the return from this project is satisfactory. Is best case, and best case we can gain a lot of profit from the investment. However, there is a high risk differ from the coefficient of the correlation value. That is the worst case may occur, and we can get lost at the end of the project adjust for the inflation. In overall, the investment in the project we will pay back in the short time period and high profit at the year end. Thus, we should the investment in the project. However, there is a risk that is the worst case may occur may not because the bad management in operating and efficiency for the machine and equipment, so that we can lose a lot from the money at the project. And this is all for our presentation. Thank you.